If you're able to record, please record. Right, we get started. Right, so we have covered standard 2A, right? Material non-public information and market manipulation. Right, so this lecture we will start with duties to client. Right, we'll cover the first three. Okay, 3A, 3B, and 3C. Right, duties to client. Okay, loyalty, prudence, and care, and fair dealing and suitability. Right. Right, so loyalty, prudence, and care. Okay, so basically loyalty to your client, right? Okay, you must act with reasonable care and exercise prudent judgment. That's the first point. Second point, you must act for the benefit of your client, right? Act for benefit of the client, right? And place your client's interest before your employer or your own interest. That means the client interest comes first, right? Okay, must determine applicable fiduciary duty, right, in your relationship with your client, the applicable fiduciary duty. So there must be a contract which specify what ought to be done, right? So this fiduciary duty will usually be about the money matters, right? And you must comply, right, with such duty, right? With such duty, must comply with such duty to persons and to interests to whom it is owed. Okay, this is what is meant by, okay, loyalty, like prudence, and care. Okay, these three concepts. Okay, I've already talked about these three concepts. So now, here, okay, so to reinforce what I've just said, right? Client interests are paramount. Of that means they are of utmost importance, more important than your employee interest, more important than your self-interest, right? Paramount. Right? So we have a duty of loyalty and duty to exercise. So, you must exercise reasonable care. Okay? Right? And you must act for sole benefit and best interest of the client, right? In your professional duty. Right? And you must act with prudence and judgment and care, as if your interests are at stake. That means as if your own interests are at stake. All right? It's very clear. So who is the actual client? Okay, right. So this diagram will help illustrate it clearer. So you have the investment manager in this instance, right? Managing a portfolio of assets, for the investor. So this is your client, right? Okay, so now you have a duty of loyalty to your client, right? Because managing the portfolio of assets is your fiduciary duty. Okay, fiduciary duty. Now, in this case, right? So now, this case, right? Yeah, you also have a fiduciary duty to say, right? So this is also like an entity, the pension fund or trust, right? In name, this pension fund or trust may employ you as the portfolio manager, right? So your fiduciary duty is to manage this portfolio of assets for this client. Yeah, this is your official client. But then again, okay, yeah, you have a duty of loyalty to your pension fund, but the actual owners of this pension fund or trust, right, are, I mean, the beneficiaries here, right? So this is just an entity, right? So in here, there may be some management or trustee who look after the interests of the trusts or funds. Okay, right? So yeah, you have a duty of loyalty to the pension trust, but you have an ultimate duty of loyalty to your client, right? So this is your actual client, right? These are this is your actual client, all right? Your ultimate duty or loyalty is to your actual client. All right. Right. So we talk about the concept of prudence, right? As a prude, it means you do things carefully. You know, you exercise caution and discretion. So you act with caution and discretion. Okay. You act with care, skill, and diligence. All right. Under circumstances that a reasonable person acting in like capacity and familiar with such matters would use. Right. So the keyword is reasonable. Right. Okay. Reasonable care, skill, and diligence. Okay, and you act following the investment parameters. Okay, according to the contract set forth by the client, and obviously, you always try to balance risk and return. Okay. Right, fiduciary. Right. So actually, fiduciary in the broad sense of the word, right? You're like an agent for somebody. You're acting for somebody, right? And that person trusts you to act for him or her, right? So basically, you're someone. So fiduciary could be a noun, could be an adjective. So fiduciary could be a person. So if you use it as a person, right, as a noun, right, is someone in an enhanced position of trust because somebody trusts you, to do something. So you are basically a fiduciary is a person in an enhanced position of trust having a duty, right, or responsibility of acting for the benefit of another party. All right. So if you manage investment assets, that means you are a fiduciary. And usually it will deal with money matters. Not always, but usually. All right. But anyway, in the general sense of the word, right, is a fiduciary, have a duty or responsibility to act for the benefit of another person. So this benefit, is not always financial, but it is usually financial. Right. So custody. Your fiduciary will have custody of your assets. And sometimes they may have even have legal title to your assets, and they're acting for acting on behalf of the beneficiary. So by having custody, right, that means basically if it's under their custody, right, the fiduciary have effective control, right, of the client's assets. That means the fiduciary can have the right or funds. However, the fiduciary will be acting or executing whatever you want him to do, right, in accordance with the terms of the governing documents. All right. So now, sometimes you may have potential conflict of interest. Okay. Right. Sometimes. So when the manager and the client have competing interests, right? Right. So sometimes if the manager wants to look after his own personal interest, if he does so, that means the client's interest is compromised. Okay. Right. So now we talk about the investment objective of client, right? Right. So the fiduciary, right, is the professional investment manager, right? Because this professional investment manager, he knows, he has better knowledge, he has deeper knowledge, he has greater knowledge than the client. That's why he is the fiduciary acting on behalf of the client. Okay. Now, the client has got some investment objectives, rate of return, things like that. All right. And so this fiduciary, right, should ensure that the client's objectives and performance expectations are realistic, right, and suitable to the client's circumstances, right? And just now we talk about having a balanced risk and return trade-off, right? So that means the risks involved are appropriate in the long term. Okay, so this is what the fiduciary should be looking at. Right? And I mean, in the event of conflict of interest, right? All right, the fiduciary should ensure that the investment manager, right, or the firm's objective, right? So the investment manager or the firm is a fiduciary, right? To make sure that the fiduciary's objective do not conflict with the best interest and objective of the client. Okay, this is a basic principle, right? And we talk about the parameters, right? So by the parameters, we mean, the guidelines, policies, or trust deeds. These are the parameters set up by the client. And you should judge the investment decisions in the context of the total portfolio, right? Obviously. Okay. Rather than by individual investments within the portfolio, because it is the total portfolio return that matters. So if you have additional investments to the portfolio, you must consider issues like correlations, which you learn in other finance subjects, correlations of a certain investments to the existing portfolio. Okay, so things like that. All right, so maybe just some extra words on this part here. Right, so basically here the fiduciary should have thoroughly considered, right, the new investment, or the additional investments placed in the overall portfolio, right, the risk of loss or the opportunities for gains, right, or even the tax implications, right, and diversification, liquidity, cash flow, right, and the even the overall return requirements of the assets, right, or even the portion of the assets for which the manager is responsible. right? So this area is quite broad here. Right. So now you're acting for the client, right? So this issue would come in, right? So you may be asked to be a voting proxy, all right? So you may be asked to cast a vote, right? So you may be asked to do, you know, so you have the issue of the proxy vote, right? Proxy, right? The word proxy, that means you are, a representative of somebody else. Somebody represents you. So you have a voting proxy. All right. So a vote is a ballot, right? So you're talking about casting a vote, voting, right? So a ballot. You're talking about a ballots here. So a proxy vote basically is a ballot cast by one person on behalf of another. So this by one person, this one person here will be your fiduciary or your investment manager. So on behalf of another. So this another will be the client. All right. So usually they'll be voting on issues like electing directors to the board, approving M&A, approving stock compensation, or change in firm capitalization. All these material issues. All right. So this fiduciary must cast the proxy vote in accordance with the client's guidelines or discretion in the client's interest, especially if the guidelines don't spell out clearly what need to be done, what ought to be done, then you must use your discretion. Because certain things are gray, not black and white. So the fiduciary must exercise his discretion in the client's best interest, right? In the client's best interest. All right, so this is what is meant by a voting proxy here. So this voting proxy together, it is a noun, right? It's another word for the fiduciary, right? When this fiduciary is acting in voting matters, right? So this proxy vote is the actual vote, okay, cast on behalf of another person. Right, so duties to client, right? So sometimes you may, be asked to select brokers, right? And the execution, right? So sometimes you may have conflicts, right? Okay, like related parties, right? Conflicts may arise when an investment manager uses client brokerage, okay, to purchase goods and services that benefit the investment manager, or a practice commonly called soft dollars or soft commissions. So now we will talk about the concept of soft dollar payments. All right, so please pay attention. Right, so now I will try to explain to you what is meant by soft dollar, right, or soft dollar payment. Right, so on your left in blue, you have GHI Brokerage, who provides both brokerage services, brokerage and say research services. Right, and on your right, you have DEF Mutual Fund. Right, so now DEF Mutual Fund wants to buy some research services from GHI. All right, DEF wants to buy some research services from GHI. And GHI is supposed to provide the research services to DEF. Right, and DEF may agree to spend at least 10,000 in commissions for brokerage services in return for these research services from GHI. Right, so they may agree on this. All right, so this is the agreement, right? GHI provide the research services to DEF. So in payment, right, quote unquote, spend, more than 10K in commission for brokerage services. So this is a very simple example of a soft dollar payment, right? So now, if you're not using soft dollar, right, DEF may have to say if these research services cost 10K, then DEF may have to pay, say, 10K, 10,000 cash, right, to GHI. That will be the hard dollar payment. But they can have this agreement whereby the payment need not be in cash, but they spend, say more than 10,000 in commission for brokerage services. All right. So if it's not cash, you have to spend more than 10K. If it's cash, you may, spend 10K, say for instance, cash. All right. So that means a soft dollar is, basically, in other words, you can say you're using some other means to pay. Some other means to pay. So this is what they call soft dollar. This would, this is one way of describing soft dollar. All right. Okay. This would represent soft dollar. Now, hard dollar, right? So now if it's more than 10K, so maybe hard dollar, since they're paying cash, right? Again, same thing, right? Same arrangement. I mean, you can pay hard dollar, say cash for the research because it's cash. I mean, if it's brokerage commission, you may only collect the brokerage commission, over a period of time. But if it's cash, it's 7,000 upfront. So maybe this is even better. All right. So there's two options. All right. So this represents a hard dollar payment. Okay. Right. So now we'll make it a bit more complicated here. Right. So now you have three parties. ABC, right, is basically a goods and services provider. DEF, mutual fund, is the investment manager, and GHI, brokerage, right, is the brokerage services provider. Right. So now when we talk about goods and services here, right, we can refer to investment research services, right? Or, I mean, if you talk about goods here, right, you can be talking about computer hardware or software, right? And this is a servicing, right? All this costs money. All right. So now, all right, this is going to be a bit more complicated, so please pay special attention. Right. So now the arrangement is ABC provides goods and services to the DEF. That's the agreement, right? And one option is for DEF to pay hard dollars, right? The other option, right, is to pay in soft dollars, right? So this is one way whereby, okay, now this is actually a tripartite agreement between the three parties, right? So DF directs the trade to GHI brokerage. And all this is made known between the three parties, right? So GHI will charge an additional fee on top of actual commission, which is actually charged to client in terms of higher commission, right? So they charge an additional fee, quote unquote. And they will redirect this additional fee to ABC as payment. Okay. So under soft dollar arrangements, right, the expense of paying for these goods and services, right, is hidden in the trading costs, right? So this additional fee is hidden in the trading costs. So the brokerage will, the trading, stock trading, right, it'll be hidden in the trading costs. right? So basically, this is soft dollar arrangement, right? So this part here, yes, right. This is a soft dollar arrangement, right? This part here, okay? So this additional fee, right, on top of actual commission, I mean, like all this normal trading, you have an actual commission, right? So you have this additional fee on top of the actual commission, right? So this additional fee is to pay for this goods and services, right? So the additional fee on top of the actual commission is actually charged to client, right, in terms of high commissions instead of being paid by DEF, right? So DEF don't pay the hard dollars. So they pay using soft dollars. Right? So under soft dollars, right, the expenses are hidden in the trading costs. Right? So these expenses are the additional fee. Okay, these expenses are the additional fee. Is that clear? Right, so now I will go a little bit deeper and we talk about unethical soft dollar arrangement. So this is unethical, right? So why is it unethical? Right, please pay attention. Right, same arrangement, right? So say for instance, right, the goods and services is worth $2, right? So this is one option, you either pay $2 in hard dollars, or you have this soft dollar arrangement, right? So in this one arrangement, you direct trades to GHI and was charged $12 commission. So the actual commission is $10, but you are charging $2 extra. So these $2, right? These $2 is redirected to ABC. All right. So the issue is about these $2. All right. So, okay, I hope you understand what I'm saying. All right. So now, why is it unethical here? Okay. All right. So paying $2. Okay. Now, why is it unethical? All right. Here I'm saying here, DEF clients unfairly pay $12 instead of $10. Okay. Okay, why is it unethical, right? They pay 12 instead of 10, right? Okay, now here, this point here, DEF clients does not benefit from this soft dollar arrangement, especially if these $2 of goods and services is just used for DEF, the company's benefit, right? If it's used directly for DEF mutual funds benefit, and the clients and DEF clients does not benefit from this soft dollar arrangement, then this is unethical. Is that clear? Right. So now, in this instance, this second example, this is ethical, right? Now, the issue here is DEF wealthy client fairly pay $12 instead of $10 because the software was used directly for the benefit, right? In this case, yeah, you still charge extra, right? Yeah, you still charge extra, but right, you note this point here at the bottom, right? DF royalty clients are not overcharged from the soft dollar because the software was specifically purchased for their benefit, right? So in this instance, it is ethical. It is okay. Is that clear? Right? This is ethical. Okay, so the key issue is whether, right, this payment in soft dollar, does it benefit the client? That's a key issue. If it benefit, that means it's ethical. If it doesn't benefit, it's not ethical. Okay. Right. So these are some of the guidelines, for recommended compliance procedures, right? So basically, you should submit, quarterly itemized statement to each client, right? So whether then the clients would know the actual amount of expense. Okay, the client can keep track, right, to see whether they are overcharged. Okay, and you have periodic review investments, should establish policies and procedures with respect to proxy voting and client brokerage. Okay, so if in doubt, disclose the matter. Here that means if there's any conflict of interest, right, and you must obtain the client approval. Right, so here, right, these are some of the topics to be addressed when drafting policies and procedure statements or manuals regarding responsibilities to client, right? So you have this like it should be in the contract. Okay, so these are just some of the suggested topics, right? That means you try to, right, this is in black and white, right? To ensure, I mean, we are, the 5D3 would be saying that we are following all rules and laws, right? And the investment objectives are clearly stated, right, in the contract. And basically, I mean, we try to have some degree of diversification, okay, to reduce risk of loss. And the mention of dealing fairly with all clients and, even the disclosure of conflict of interest. So all these issues should be, in the policy statements. Right, and how much you're paid, and whether the fiduciary would be a voting proxy, right? And the issue of confidentiality, that all information of the client with the fiduciary will remain confidential, right? And you will seek best execution for the client, and last but not least, right? You place the client interest first, right? All these issues must be mentioned. Okay. Right. So now we talk about some case studies on 3A. So the issue is about identifying the ultimate client, right? The ultimate client are usually the participants, right? The beneficiaries, right? So you have First Country Bank, right? Serve as a trustee for the Miller Company's pension plan, right? Miller Company has a pension plan, but First Country Bank is appointed as a trustee. Okay, right. So this Miller Company, right, is the target of a hostile takeover attempt by Newton Co. In attempting to ward off Newton, Miller's manager persuaded Julian, right, an investment manager at First Country Bank, to purchase Miller common stock in the open market for the employee pension plan. Miller's officials indicate that such action will be favorably received and will probably result in other accounts being placed with the bank. Although Julian believes the stock to be overvalued and would not ordinarily buy it, he purchases the stock to support Miller's managers, right, to maintain the company's good favor and to realize additional new business. The heavy stock purchases caused Miller's market price to rise to such a level that Newton Incorporation retracts its takeover bid. So the issue here is whether the fiduciary act prudently and solely in the interest of the plan participants and the beneficiaries. That's the issue here. Okay, so now maybe this case is better illustrated with a diagram, right? You have Newton Incorporation wants to take over Miller Company, right? So this is the issue here. And you have First Country Bank, right? First Country Bank is acting as a trustee for Miller Co, right? So I mean, this exercise here, I mean, it's a good practice. I mean, if you are having difficulty understanding a case, it may be a good idea to draw a diagram like this, All right, so First Country Bank acts as a trustee for Miller Co. Right, so the managers at Miller Co, persuades Julian, right, at First Country Bank, right? Persuades Julian at First Country Bank to buy some stock to support, right? So this is the issue. All right, is that clear? Right, so as a result of this, right, Newton Co retracts the takeover bid. All right, sorry, retracts the takeover bid. Right, so the issue here is, right, Julian, on behalf of First Country Bank,